content. First, brief introduction of Opus Connect. Opus Connect was founded by Lou Sokolowski, who's also the founder of Gennaro Capital Partners. We have chapters all across the country in LA, New York, San Francisco, Chicago, and Orange County. And each of those chapters has monthly seminars. Those seminars are those seminars are usually panel discussions where our members get together and network, discuss different topics in business, and get to know each other. We also have special events, those are the events that I run. Those include these webinars and our speed networking events, which are similar to speed dating, where we get either fund sponsors and capital providers or investment banks and private equity groups together, and they quickly, briefly, and efficiently meet everyone. Our membership is by invitation only. It's to make sure that we have quality members. However, you are invited to attend 2 Opus Connect events free of charge simply by speaking to us. So that's just Opus Connect overall. If you have any questions about that, feel free to contact either me or Lou. We will be sending out our contact information after the webinar. And so now I'll pass it off to Rich Erickson, today's moderator, and I'll go ahead and give you a little brief overview. Rich?
Great, Nick. Thanks so much, and thanks everybody for attending our panel. I think we've got a great group today that includes Tom Alphalter from Victory Park, Tom Henderson from Accord Financial, Chris Sheeren from Huron Capital, and Michael Teplitsky from Wynnchurch Capital. We hope to give you some real insight in terms of the perspective of capital sources for independent sponsors today. By way of introduction briefly, I am one of the co-founders of a firm called Red Oak Growth Partners. We are a lower middle market focused private equity firm focused on businesses typically with $2 to $15 million of EBITDA in software, business services, and information services investing. We founded the firm in 2012 after my partner and I had previously worked together at a private equity firm called Updata Partners. I had spent the majority of my career previous to the investment component of it as an operator for 22 years in public companies and private companies as CEO, COO, and founder, and the past 10 years as an investor. We tend to focus on businesses that have high degrees of recurring revenue, generally are owner or founder operated, oftentimes bootstrapped, and will look to do majority recapitalization transactions with those businesses and help the founders in both growth capital as well as strategy in accelerating their business model. Today, I'd anticipate our panels are going to go for about 40 minutes, and then hopefully we'll have about 10 minutes for Q&A at the end. With that, what I'd like to do is hand it off to each of my panelists and give them a quick opportunity. And Nick, you can move to the next 2 slides and introduce Tom Alphalter of Victory Park.
Thanks, Rich. Tom Alphalter with Victory Park Capital. We're a fund located in Chicago. We manage about $1.5 billion currently out of 4 different vehicles. We're really a credit-focused fund. We work a lot in the both distressed arenas, which we invest out of our second fund, which is our private equity fund, and then our SBIC vehicle, which is our newest fund. It's a $225 million SBIC fund. That fund is, I think, the most appropriate fund as it relates to this discussion today and working with independent sponsors and smaller private equity funds. We are a unitranche-focused senior through mezz and co-investor in buyouts, growth equity opportunities, and we have worked with a number of independent sponsors and look forward to talking today, and thanks for having me.
Great. Tom, thanks so much. I'm going to turn it over to our second Tom in a second, Tom Henderson from Accord Financial.
Good afternoon. Thanks, everyone. Our company has been around for 35 years. We're a public company in Canada with a strong balance sheet, and our source of capital is domestic institutions in the U.S. and Canada plus offshore capital. We are very lightly leveraged. We're basically in each transaction lending the bulk of it's our own capital. We provide facility sizes in the U.S. and Canada from $1 to $20 million, and we only finance underperforming companies, and most of that we do with independent sponsors who are buying opportunistically, in many cases, spin-offs from major corporates. The bulk of the transactions that we have done in the last 5 years do not require an equity check from the sponsor because there's ample collateral available in the entity that they're buying, and because we believe the shirt sleeve type people that we work with are going to fix the issues that have bedeviled these companies. We operate across many business segments. We're collateral driven, so we're not doing cash flow transactions, obviously, in these matters. We're looking at receivables, inventory, and M&E. We are unique in that we don't employ business development people. So when folks call in here, they're talking to somebody from our credit committee, and we try to get to closings very, very quickly. My career has been extensive with a company called Heller Financial for many years, and then the last 16 years with Accord. And what we look for in an independent sponsor are those who are value buyers who are looking to execute multiple transactions a year, and that they are hands-on operators experienced in turning around underperforming companies. These are the people that we look for, and of course we love those who have a lot of discipline and willing to walk away from a deal that doesn't make sense.
Great. Tom, thanks very much. Chris Sheeren, let me turn it to you.
Thanks, Rich. My name is Chris Sheeren. I'm at Huron Capital Partners. We are a private equity firm based in Detroit. We also have a Toronto office, and so we invest really across the U.S. and Canada. We make majority investments in healthy companies, companies with generally at least $5 million of EBITDA in a variety of sectors, and those are, generally speaking, niche manufacturing, business services, consumer, and healthcare. I joined the firm about 10 years ago, and have been active on both the deal side and the business development side. We have done 4 deals over the years, excuse me, with independent sponsors, and would love to do several more here. We just recently started investing out of our 4th fund and have a handful of opportunities under letter of intent, but are always looking for more opportunities. If you and Rich, you could flip forward in terms of what we're generally looking for in an independent sponsor. Ideally, it's the ever elusive proprietary deal. Now, we do have 2 business development folks who are devoted to covering the independent or the investment banker and broker community. So we think we've got pretty decent coverage of deals that are shopped. But there's any number of opportunities that independent sponsors bring us that we don't otherwise see, and that's a huge value to us. And so along with that, then generally we're looking for kind of reasonable, fair market terms, economic terms, transparency and an open and honest and communicative process. And then ideally some specific industry expertise, either from something that the independent sponsor has done in their own background or in the form of an executive that they may bring to a particular situation. So thank you for having me today.
Thanks, Chris. Michael, I'm going to hand it to you.
Yeah, appreciate it, Nick. Thank you for letting us take part in this. I would echo a lot of things that Chris has said in terms of working with sponsors, but the background on Wynnchurch is that we're a Chicago-based private equity firm. We focus on value and operational type of transactions. We also have an office in Detroit and in Toronto, so we're actively doing deals across U.S. and Canada. And most of the focus here is really on manufacturing companies. That's probably 80% of what we do. We also get really involved with other types of businesses in value-added industrial services space. And over time, we've developed an expertise in acquiring both healthy family-owned businesses as well as corporate divisions, both healthy and underperforming, as well as businesses really in need of an operational turnaround where there's a good company and a bad balance sheet, or a company may be having really financially oriented type of distress issues that may require a formal bankruptcy process. And these are really companies doing $50 to $500 million in revenue, and if you look at the portfolio today, you'll see it spanning the gamut of agricultural equipment, energy, mining, housing, and then safety products as well as automotive. And we're spending a lot of our time these days in industries going through transition, such as the military product space, some pockets of agricultural equipment, and pockets of mining. But that's those are more of the healthy deals that we've done on that page you just saw. In terms of turnaround, we will absolutely buy businesses that are unprofitable. Few of the businesses on this page we're losing as much as 20 to 30 million in cash at the time of acquisition. So we can be kind of a one-stop shop for sponsors looking for a partner for both healthy and underperforming deals. And
Great.
What do we really look for in sponsors? I'd say it's really three things. It's number one, having a similar type of investment philosophy as we do. So value-oriented, operationally focused, more in the industrial space. So somebody brings us a consumer products or retail or restaurant business that's trading for crazy multiple, that would not fit us. But if somebody brought us a manufacturing company that was well-positioned and had identified growth that we could buy for 5 times, that sounds pretty interesting. And then second, we look for an independent sponsor with some sort of an operational or an industry angle. So further to Chris's point, if it's just a banker book that we haven't seen, we definitely still want to see it, but we would prefer to see that deal not as broadly shopped. And then finally, somebody with whom we could figure out exclusivity pretty early on. We have zero interest in some sort of a bake-off for capital providers early on in the process. So anyway, that's the synopsis on our approach.
Great. Well, Michael, thank you. So let's dive into the panel. And for the first question, what I'd like, and Nick, if you wouldn't mind forwarding, the first question I'd appreciate the panel responding to would be, what are the things you like about working with the independent sponsor model and some of the things that maybe you don't like? Tom, why don't I direct that to you first? Henderson.
Okay, good. So what we like is that the independent sponsors that we've been fortunate enough to do business with over the last 5 to 7 years seem to be very decisive. I don't know if it's because they don't have a lot of equity participants to consult with, but they're very decisive, and they prefer to try to close transactions quickly. They're very opportunistic. So with the lack of bureaucracy, they kind of push us, how fast can you close this? Because they all love their transactions. And when they get to the stage where they think they can hit it out of the park, they want to move very quickly. And that really plays to our strengths because we sell the fact that we will move quickly. And it's usually things don't change much along the way when we deal with the independent sponsors. We like them to consult with us as they're developing their business model. Remember, all these transactions that we see, there's a troubled background, and we don't like to all of a sudden be presented with, here's what we're going to do. We ask them to bring us in very early and show us their own model as they're developing it, as they're determining what they would do with the business, so that we can kind of buy in from the very beginning. And if we have any major problems, we can let them know right away that that might be beyond our appetite. And of course, one thing we really, really like about the independent sponsors is they're willing to pay a fair price for our debt, recognizing that there's a control trade-off. We are permitting them to leverage what capital they have to the maximum, and in so doing, we're allowed to get a fair price for our funds. So we certainly love that. That's the honest truth. Yeah.
Well, no, and Tom, thanks for the debt perspective there. Chris, why don't I ask you the same question, obviously from an equity perspective?
Sure. So, a couple of things. I guess I mentioned the things that we look for are there's a little bit of overlap here in things that we like. So, first and foremost, it's access to opportunities that we're not otherwise seeing, and ideally, or often at very, at a decent purchase multiple, to the extent, it's not a broadly shopped situation, and to the extent that the event sponsors have been able to develop a relationship with the seller, very often you find very nice opportunities here that again we're just not otherwise seeing. Again, oftentimes, as I indicated before, one of the things we look for, one of the things we like is an independent sponsor that brings an angle, whether it's through their own personal experience in a particular industry or for an executive that they're bringing to the table. That's certainly something that's important to us in every opportunity. We try to ask ourselves how we can bring value to an investment. We want to justify our own existence and figure out how we can bring value. And if there's already an executive or some other experience that's being brought to the table, that's great. The other thing that really can be really appealing in most cases is that unless it's a very early stage of a more broadly shopped process, set that aside. Most of the independent sponsor opportunities that we see are somewhat developed, and they may be close to an LOI. Sometimes an LOI has already even been signed. Those are real live deals, as opposed to if we look at our deal funnel for the year, and there's a big wide point at the top, and whether it's 1,000 deals or whatever a firm looks at in a year. These deals almost by definition are ones that have trickled down into the sphere of real interest, and so it's pretty easy for us to get excited about a real live deal that's already passed through several screens. So that's something that we like a lot. I know Tom maybe didn't talk about the things that they don't like, and there certainly is a lot to like about the model. I guess I'll hit on maybe a couple of challenges that we might have from time to time. There is the potential for confusion, I think, amongst on the part of the seller, when the seller may have had a relationship with the independent sponsor, and then suddenly this random third-party equity group comes into the picture, and so a lot of that's incumbent. Managing that process is incumbent on the independent sponsor to make sure everybody's up to speed and everybody who knows who all the relevant parties are. But we have in the past, I think, it maybe had some confusion with our sellers on kind of who their relationship is with, and it's who they're going to be working with going forward, and hopefully the answer is all of us. But that's a potential challenge. And then we also sometimes we'll have, and I think we'll talk about economics later. And as this market is maturing, this independent sponsor market is maturing, I think there are some economics that are getting a little bit more. There's a little bit more definition of a market for some of these things. But most private equity firms like ours, unlike maybe a family office, we can't afford to give a 20% carry that just that often creates a challenge, and there are some independent sponsors out there that are looking for that as a hurdle for them. So occasionally we'll have some challenges with economics, but for the most part, that all gets worked out.
No, that's great, Chris. Well, we appreciate the insight, and we'll spend more time on the economics a little deeper into the panel. Maybe for a second question, let's talk about how do you build relationships and identify independent sponsors, and maybe Tom Alphater, you could start with this one.
Sure. We kind of, I guess it's a good segue from the last question. We like working with independent sponsors. We have closed a few deals with independent sponsors. I think I'll give Lou a plug here. This organization, Opus Connect, has been a great opportunity for Victory Park to get introduced to a number of independent sponsors over the last couple of years, and so we're very active members in this organization. We will continue to be. Anyone who has not been to some of the local events in New York, Los Angeles, we just had one on Monday here in Chicago. I strongly encourage you to attend. I think you'll find a lot of good capital providers and a lot of good deal source opportunities at these types of meetings. I think the other way we search for relationship opportunities with independent sponsors is hitting a number of different conferences. We travel the country to seek these types of opportunities. We try to market ourselves as best as we can with websites and the traditional marketing sources. And I think importantly, we've become a very trusted partner with these types of deal sources. We've closed deals. We're I think good partners to work with, and we've demonstrated that we can be flexible and creative in our capital structures, which is much different than the traditional lending sources out there. The other thing I would add is Victory Park has built although we're industry agnostic, we've built expertise in a number of industries, and so I think just by default we're seeing deals in those opportunities in those industries, and those would include restaurants and quick serve type restaurants and franchise models, distribution businesses, transportation businesses, and energy businesses. We've seen a number of deals in energy service and oil field service type of opportunities.
Thanks, Tom. Mike, same question to you. How are you building and identifying the relationships of the ISs that you want to work with?
Well, I definitely agree with Tom. I think Opus Connect has been a really good source for new relationships. Wynnchurch has been in business for around 14, 15 years, and over time we obviously have gotten larger, but we still keep relations with many people that we've done deals with over the years, and over time we've done deals with independent sponsors. So it's about relationships, and this industry is absolutely amazing. The independent sponsors all talk, so if you have a good experience with them, I think they'll tell other people about that, and then if you have a bad one, they'll probably tell them as well. So we've tried to be good stewards and good partners with on deals that we've been shown. Outside of that, we've done some receptions. We've taken some independent sponsors out for dinners, things like that. We've taken part in different panels and Opus Connect events. So I don't think anything really out of the ordinary. Here's what I would say, that I think it's actually very tough to really figure out by looking at websites who independent sponsors are, because their websites look just like funded sponsored kind of organizations. So, for example, I spoke at an event a couple of weeks ago, and then I got the attendance list, and I had plans to go through it and reach out to people I didn't connect with. I just haven't had time because I went to a couple of websites, and they all looked like funded private equity groups. So it definitely is a niche market.
Okay. Now, look, that's an interesting point that you did that, but I think it's fair to say being proactive as an independent sponsor to someone that may be a fit, you guys are I think, pretty open and warm to calls and interested in getting that. Nick, let's move to the next question, and I think it really is around this timing issue. And when do you guys as capital sources want to see a deal? And I ask the question in the context of does the deal need to be in exclusivity prior to you seeing it? And kind of how early is too early? Because there's a little bit of from the independent sponsor's perspective, they've got to figure out, do I have the deal far enough along to share it? Is it locked up? I think they think, everybody thinks hard about that. So I'd be curious on what your thoughts are. Chris, why don't you take this one to start?
Sure. Yeah, that's I don't know if there's a perfect answer for this, and we've talked about this and thought about it a lot. I mean, my blanket response is always, just please show it to me at some point in time, either early, later, or sometime in between. We just want to see it. That's that may sound a little glib. I guess to put some more content to that, I guess if it's a process and it's being represented and there's going to be a whole bunch of management visits, we don't want to see that right away. I mean that's again, chances are we're going to see that anyway, and it just creates confusion if we see it early. So if it's being represented by any, to much of a degree on the sell side, then we'd probably rather wait till it's much closer to exclusivity in that certain circumstance. If it's more of a proprietary deal, I guess, and bringing in a group like ours would be helpful earlier in the process. That's okay. I've spent a good chunk of my time, trying to cultivate proprietary relationships, and I'm happy to spend that time on behalf of Huron. working together to to wrestle an opportunity to the ground, or wooing a seller, or whatever you want to call it. So in that case, we're happy to participate earlier than later. But generally speaking, sometime around the time of exclusivity is probably ideal. I know that sounds a little wishy-washy, but the reality is, it's again, I think it's I don't know that it matters in every case all that much, as long as we're being included.
Okay. Tom Alphalter, same question.
Yeah, I think, and this is an important distinction, I think, between, Chris and Mike and probably Tom and I. We are a lender. We don't have any interest in being a control investor in these types of deals with independent sponsors. And so we're happy to see the deal as early as the sponsor starts to get involved. I know that the challenge can be, how am I going to finance this deal if I'm sitting in the IS shoes, and how am I going to structure my deal, and how am I going to show credibility to the process if I don't have capital? And so we're happy to lend that balance sheet and that credibility, if you will, to the process. And we're happy to look at deals as early as, when the SIMs are sent out to get a read on the deal, or as late as exclusivity. I think Chris I agree. I mean, we're happy to look at it at any point, but we want to see it at some point. And so I would say the earlier the better, in our opinion. And the one challenge, and this isn't really necessarily entirely tied to this question, but the one challenge we sometimes do have is, as a lender, we might be, and we cover a number of sponsors, we might see the same deal more than once. The challenge isn't so much that we can't work with more than one sponsor. The challenge sometimes is when we get to the NDA stage and an independent sponsor is looking for non-circ or just exclusivity in the process. That can be difficult for us to do early on if it's an auction deal, and other sponsors will be looking at it, because, again, we're not looking to buy this company. We're looking to lend to it and perhaps even co-invest in the equity.
Okay. Look, that's helpful. I'd say one thing that we've seen helpful at times is to maybe share a blinder profile of a deal and kind of what it looks like with a few of our capital source relationships, to take their temperature in terms of look, feel, et cetera, and warm them up to something before we may be in exclusivity, but at least give them some knowledge of it. And I find that helpful in accelerating the process when we get to a point where we're very close or in exclusivity, to move it forward quickly. So that's one of the things that we've done pretty successly.
Well, I think that's a great idea, Rich. And sorry to interrupt you. I think that's a great idea because, again, I think it's the challenge, in my opinion, in this space, in this industry with independent sponsors is it's great to be exclusive, but sometimes getting to exclusivity is a challenge if you can't demonstrate to the seller or the advisor that you have the capital to make the acquisition occur.
Yep, I agree. And in that case, you may not be naming your partner, but you can at least communicate the fact that you've got, several parties that are quite interested, and you could, you'll communicate that as you get closer. Let's go to the next question, Nick. And, I think this is just kind of a follow-on to that, which is, look, as these deals are coming together, terms are getting created by the independent sponsor with the seller. And I think the question really says, when do you guys want to be involved as it relates to the term, or feel like you need to be actively involved? I've seen, a variety of ends of this spectrum. So I'm going to, Mike Teplitsky, let's start with you.
Well, I think the obvious answer is we'd like to be in as early as possible. Well, it may not be as obvious of an answer, but we would like to be in as early as possible so we can help the independent sponsor, number one, sell themselves to the advisors, to whomever is selling the business, or to the stakeholders, and then number two, to get to have influence and the voice in the valuation and the structuring of the transaction. And I think all of us online have maybe once too often of a time have seen an independent sponsor deal get signed up at a valuation that's not market-based, that's above market, and then try to fill the equity capital or debt capital void. And that honestly does not help anyone. It doesn't help the independent sponsor, it doesn't help the equity sponsor, it doesn't help the lenders or the sellers, because that would most likely lead to fatigued or busted auction. So the earlier that the actual group that's going to provide the capital can get involved, I think it can mitigate the risk for everyone in the value chain.
Great. Tom Henderson, how do you think about that?
Yes, it's we often, working with independent sponsors, we're often invited in early when they're planning what their offer will be and where the capital will come from, because what we'll be able to tell them is the extent to which we can, as a senior lender, reduce the need for capital. They then decide they're going to look for capital from the seller, bring in a funded sponsor, and we help them work through what their options are to buy this particular asset. So we get the question put to us very soon after they think they like the company. They're asking us what we can lend so they can figure out where the equity gaps are, and we're happy to do that. That's what we're here for.
Sure. Well, and maybe as a follow-on, and Chris, I might direct this to you. Just when is the right time for the independent sponsor to be talking, I'll call it their terms with you? Because there are kind of two facets to this if you think about it, right? There's clearly the deal itself in terms of what the seller's going to get, but there's also the component of what the independent sponsor's going to get. And when are you typically having that discussion?
Yeah, it varies. My preference is to certainly have that discussion sooner than later. You don't want to be well down the path and everybody's spent a bunch of time and money and oh yeah, we'll figure that out later. We'll figure that out later, and then you get to later and you realize you're on two different planets. That's not good for anybody. The tension against that a little bit sometimes is that our preference is to again, I'm jumping ahead a little bit to the valuation question, or maybe the terms question, but our preference is to toggle things a little bit, the compensation, to make it reflective of the post-closing involvement, the degree of post-closing involvement of the independent sponsor. So if they're going to be more involved, you might increase the carry piece. If they're going to be less involved post-closing, maybe you're paying more up front. So at some point, we'd like to be able to kind of be able to have made that determination collectively, and then maybe adjust the terms from there. But maybe you can evolve that after you've agreed on at least the bulk of the terms, and we don't really have a hard formula. Go ahead.
Chris, why don't we just segue, and Nick, we can go to the next question, because I think it's going to flow naturally for you into this since you've got the floor, and why don't you just segue that into this question around what are the kind of key components that you think about for the economics of your relationship with the independent sponsor, and kind of the levers that you pull.
Yep. And levers is the analogy that I like to use. There are generally three pieces of the compensation, which most of the folks on this call are probably familiar with, but perhaps not everybody. So I think it bears stating. You'll have a closing fee. You'll have and the closing fee will generally be a percentage of the deal value, and that could be anywhere from say 1 to 3% of the transaction value. You'll have a management fee, which is typically in our case we'll typically have that be tied to the company's EBITDA. So if we're going to have a management fee of 5%, if Sheeren's going to have a management fee of 5% of the company's EBITDA, maybe not to exceed some certain amount, or not to or no less than some certain amount, we would generally look to split a portion of that with the independent sponsor. Maybe it's 80-20 or 75-25. And then there's an equity portion, a carry that we will always have tied to our return, and times capital is often the easiest, and so it's after some sort of return to us, we will basically share in the upside with the independent sponsor, and that upside piece will ratchet up with our increased times capital return. So it's, let's say at 1.5 times, the independent sponsor gets a certain percentage, and then, at 2 or 2.5 times that goes up, and if we get north of a 3 times capital return, then we'll, it'll maximize at that level. Those aren't hard and fast rules. We don't have really a set formula, but that's pretty close to what it is. And so you look at those 3 pieces, and again, as I mentioned earlier, we'll tend to toggle those and view those as interdependent sort of levers, and maybe, again, usually tied to the post-closing involvement of the independent sponsor, and sometimes it may be tied to just what the preference of the independent sponsor is, and they may be looking for more of a fee, more on the front end because of other liquidity needs or whatever else that they have. That's fine. We can do that. Or maybe they're going to be very involved post-closing and are looking for more of an upside piece, and that's okay too. The other related issue is for some folks is rolling over that closing fee into equity, or reinvesting that in the company, and what portion of that fee would we expect to be reinvested. And again, we're generally open-minded. Everyone's situation is a little bit specific to them, and may have some needs, some more current liquidity needs that they need to take care of. However, I guess if the independent sponsor were wanting to take all of the fee off the table, not roll over any of it into a direct investment, and yet we're still asking for a large piece of the carry, then that doesn't quite sit well. We're definitely looking for skin in the game, and ideally, if it's a deal that they're excited about, you would think, and I say the independent sponsor is excited about, you'd think that he or she would want to, directly invest as much as she can, or he can, into that deal. Said differently, we would look a little bit, we'd get a little concerned if they got all excited about this deal that they were wanting us to do with them and then didn't want to invest in it.
Okay. Since this, I think, is a question I think a lot of our audience is going to be interested in, I'm going to ask actually each of you guys to take a quick hit at it if you could. Tom, do you have any comments to add?
No, I think Chris hit it on the head. I think there's a lot of levers that can be pulled. I think it really is deal determinant, and how much involvement the independent sponsor has in the deal, or whether it's proprietary or whether it's been shopped. I think it can be a tough question to answer. We think as a lender first, and so we're looking to price and structure our debt and perhaps our equity in accordance with the way we review the deal and the opportunity, and how we review the risk. I think that the deals we've done with independent sponsors, the typical negotiating points are as exactly as Chris said. It's going to be what happens with a closing fee. Honestly, don't love seeing cash go out for a closing fee, especially in a process that was a shopped deal by an investment banker. And then the other key components secondly, are going to be the management fee, and how much I think that is, again, determinative on how much involvement the sponsor is going to have in operating the business on a day-to-day basis, or is it just a portfolio account that they look at once a quarter. And I mean that, obviously it can vary depending upon how involved. And then lastly, the carry. And I think, as Chris said, again, to reiterate, it's going to shake out somewhere, and 20% seems aggressive typically, and it's probably going to be something less than that. But I have seen deals where it's been more than 20%. It's just where it's been an operator that can kind of quote unquote be an independent sponsor, but it's an operator that has a proprietary deal and is really bringing value to the table above and beyond just an opportunity to invest capital.
Okay. Mike, how about you? Well, anything you want to add here?
I guess the one thing I would add is the equity portion. A lot of, and I know the whole thing is flexible and there are a lot of moving pieces, but here's what I would say. Once we hit some sort of a hurdle, let's say 3 times, 3.5, 4 times, it's much easier to share economics once we make what I would call a breakout return. And I know a lot of independent sponsors want to make sure they're protected at much lower levels, like 1.5, 1 3/4 times, 2 times, it's much easier for us to give a disproportionate share of the economics above 3 times, 3.5 times than it is at lower levels. And the other thing that I would add is the following, that and maybe I've given this too much thought. I actually think that the independent sponsor model works best with, and Wynnchurch does these complicated or storied deals. I actually think that the independent sponsor model works best for these kind of deals because invariably there will be, because there's more risk, there's more upside. The more upside there is, the easier it is for the funded equity group to share the upside with the independent sponsor. Whereas if an independent sponsor brings what I would call a premium asset that's broadly shopped by an investment bank, and you're splitting hairs on returns between 1.5 and 2 times your money, I think there you've got trouble. I think it's tougher to make it work for everyone.
Okay. And Tom Henderson, anything else you want to add?
Yeah, just one thing briefly. So we're looking at this. We're strictly an asset-based lender. We never take upsides. We never take any sort of equity. We're making a loan, which usually with independent sponsors does not have a closing fee, and quite often does not require capital from the sponsor. In other words, if we can fund the entire downstroke of the purchase price, and we like the story, we like the sponsor's model, we'll go ahead and fund 100% of that. That's obviously a big selling point to independent sponsors who have limited capital, and but we can't do that in every case, but we've done it enough that the word has spread.
Okay, great. Nick, let's move to the next question. So we've talked a lot about kind of the process. I think it would be great also to hear from some of the experiences each of you have had, or what have been some of the challenges in working with this model? And maybe Mike, I'll ask you to kick this one off.
Can you clarify that question?
Yeah, just, I mean, in working with the independent sponsor model along the way, are there things that you would say, just be aware of, this could be challenging?
Yeah. I think the biggest problem with these deals is valuation, because we can get through a lot of other issues, but a lot of times the independent sponsor, and this is part of the value add, is the independent sponsor finds the deal, bakes it, if you will, and then hopefully locks it up at some price. The biggest problem that we've seen is that price a lot of times is outside of market norm. And that's maybe why they were able to lock it up to begin with, because they offered to pay the highest price. So now, as I think it was Chris from Huron that said this. However, even if it's a slightly higher price than you may want to pay, because it is a live deal and it's not in the beginning of the funnel, it's maybe in the middle of the funnel, as in much more credible transaction. As a funded equity group, you may be willing to pay a sliver more if you really like the deal, because it's a real transaction. So the valuation is the key.
Okay. Any comments from either the other panel members on this question that you'd like to highlight? Tom Henderson, anything?
Yeah, the only issue is sometimes independent sponsor has an unrealistic assumption about how fast a closing can take place. These people like to race to a closing when they have a good opportunity, and we struggle to catch up sometimes. But other than that, that's the only issue that we face.
And Tom, just give a little definition to that from your point of view. What's the amount of time I mean, it's probably not fair to say typical, but what would that time be in terms of the expectation?
Well, just have, it's a topical question. It just came up today on 2 transactions that basically came in overnight, both looking for end of April closings, and both are complicated. Both require us to get appraisals on inventory. Yeah, we've told them both, we'll try, but that sounds too optimistic. But yeah, they'll look for closings within a month of showing us a SIM. They want it to happen really fast. So we struggle to keep up with that sometimes.
Yep. Chris, anything to add on this one?
No, I think hopefully I addressed some of those earlier in my earlier comments.
Well, look, I think we've got about just under 8 minutes left, so I've gotten a couple of questions from attendees, so I'm going to open it up to questions, but maybe I'll kick one off that I've seen from an attendee, and that's on, and I'll throw this out to the panel, and that's on deal costs. Independent sponsors oftentimes, from my experience, are, kind of thinking about, how am I going to fund deal costs, and, is my sponsor going to help me do that, and how does that occur? I'd be curious if you guys could take that one.
I would say from Wynnchurch, we would take care of all the deal costs if we get involved very early and we're the ones that are driving the shell of the service provider universe and coming up, negotiating with the service providers we use. If somebody brings us a deal that's, where the independent sponsor already spent money using their own sources for diligence, I think it gets more complicated when that happens.
And how about if it breaks, Mike? What happens?
Well,
so if the deal doesn't happen.
Well, if we get involved, let's say very early on, hypothetically it's a shop process, but maybe not a big bank, but the business broker or something like that. And if we're partners with an independent sponsor, we will take care of the burden of the deal expenses.
Okay.
If somebody brings us a deal that they've already spent money, and then we do some work and then it dies, I think it gets more complicated there.
Okay. Chris, how about you?
Yeah, I guess I just add, as a general rule, that's part of the trade-off of working with a majority equity investor. You're going to have to cede control on certain things. In post-closing, we are going to need to have a majority of the seats on the board, although you, the independent sponsor, are certainly welcome to have one. But we need to have a majority of the equity and a majority of the board seats. But we will generally, like Mike said, we'll generally bear the risk and the costs. And that's one of the trade-offs that you make. And I think it's a good part of it, certainly, to really protect the independent sponsor from getting way out and exposed to 50, 60, 80 grand to an accounting firm and Lord knows how much more to the law firm. As long as we have a say in maybe to clarify what Mike said, as long as we have a say in who those professionals are, and we're going to want to have a say in who those professionals are, then we're happy to bear the risk and cost.
Okay. Another question that's come in relates to just how common are you guys seeing independent sponsors that are coming from maybe a private equity firm that is in between funds, is trying to kind of maybe raise their next fund but is tapped out on their previous fund? Are you seeing any of that?
This is Chris. I guess I'll start. You certainly see some of that, I suppose, and there are groups out there. We haven't really talked about just a broader comment on the universe of independent sponsors, but it varies from well-established firms with 6 and 7 professionals who look for all the world like a private equity, like a funded private equity firm on their second or third fund, to a single shingle, an ex-operator or an ex-private equity fund person who's fund but not raised a subsequent fund. Whether they're in between funds, I don't know. I might question that specific notion. It's really more. I think what I see more of is again folks who were part of a fund that for one reason or another didn't raise a subsequent fund, or that person just wanted to leave and do something more entrepreneurial. That's the most common profile that I see.
And maybe that's the better way to ask this question to the group, which is, where do you typically see the independent sponsors coming from? And is there typical? It sounds like we've heard operator, we've heard ex-private equity, we've heard banker, but I'd be curious what the panel thinks.
The interesting, this is Mike from Wynnchurch. The interesting thing about that question is that I think a lot, it's kind of user-defined, it's become user-defined, and you've got even some business brokers who are now, for some or all of their deals, calling themselves independent sponsors. And that then begs the question is, at what point is there a difference between a business broker and an independent sponsor? In my mind, it's in terms of value add. An independent sponsor is going to find a deal that somebody could buy at an attractive price with a great upside. A business broker may find the same. So I think that's pretty interesting, is that dynamic.
Tom, any comment here on where you're seeing your deal flow and the types of independent sponsors from?
Yeah, this is Tom Henderson at Accord. Most of the sponsors that we've seen look like they have funds. They have, between, let's say, 4 and 10 professionals and associates running around. They look like a real thriving, established, funded business, but yet they don't have funds. Now, we've seen some of them switch. They, especially after they develop a track record, they've sold 1 or 2 assets, and now they go out and raise funds. But that's kind of rare. The ones that we've seen look like a funded sponsor, but they're independent, and they tend to stay that way.
Yeah, I think we see both. I think most of the groups that we see are either pretty involved on the operational standpoint, may have been former private equity pros at a fund, but have a little more involvement operationally and have had some management experience. But we don't necessarily draw a big distinction there as far as groups we want to work with. I think it's both are either can work. We see the range from just one person that's out looking, out searching for deals and is a former private equity professional, all the way to groups that have, like Tom said, 10, 15 folks on staff that just happens to not have a fund associated with it.
Great. Well, look, we've used our hour. I think we had a tremendous panel here. I hope everybody on the call was able to get value from it. We were appreciative of you giving us the time and Opus Connect for hosting the event. And I'm going to turn it over to Nick from Opus Connect.
Great, thanks so much, Rich. And thank you again to our 4 panelists, Tom A, Chris, and Mike. Just a few notes for our attendees. Later today, you will receive a survey about today's webinar. Actually, that happens when you log off. So please go ahead and fill that out. Let us know how we did, what you liked, what we can improve on. You're also going to receive an email with contact information for each of our panelists and our moderator. So if you have any more questions for them, or if you want to, start networking with them, feel free to reach out. You'll also be receiving in a few days a link to a recording of the webinar, and that's something you can share. You can watch as many times as you like. In case there's something you missed. You're also going to receive an email with the slides from the PowerPoint. So if you were on the call but weren't on your computer, weren't able to see them, would like to see them again, you'll have that opportunity. If you have any questions about Opus Connect or about this webinar program, please go ahead and contact me. My information is right there. If you are interested in Opus Connect long-term, again, our potential members are invited to attend 2 Opus Connect chapter meetings free of charge. So when you get that email in just about an hour, you will also receive a link to our calendar. So go ahead and look at any events that you might have in the area near you that you would be interested in. That's about it for us today. Thank you again to our panelists and our moderator, and to our sponsors, of course. And thanks everyone for attending.
Thanks all. Bye-bye.